Hi class, this is Liz Brown with Accounting 2301 Financial Accounting with Richland College. This is a review for Chapter 3. We're going to hit some of the highlights of the chapter and then move into 2 sample problems. So let's start with Chapter 3. You should have already completed your readings in the book, and please take a look at the other supplemental information on eCampus, such as McGraw-Hill videos and the presentation slides, etc. Chapter 3 covers a lot of information. So we talk about cash versus accrual. We talk about adjusting entries, which we will do an example on. The adjusted trial balance, which is very similar to our trial balance that we did in Chapter 2, except now we're adding those adjusting entries, like some of the entries such as depreciation, etc., that we'll do in our adjusting entries example. And then we're moving to the financial statements. So this was a concept that we covered in Chapter 1, but now we're looking at it and we're really taking things from the adjusted trial balance and putting those into a financial statement. Then we do the closing entries, where we're closing out our temporary accounts to retained earnings. We'll take a quick look at that. And post-closing trial balance. So this is our trial balance after we close out those temporary accounts. So before we jump into some examples, a couple of other things I wanted to mention. Depreciation. So this is something that is mentioned here in Chapter 3. It is something that we will cover in a full chapter. So we will have a full chapter later in the class on depreciation and fixed assets. So what I want you to take away in this chapter with depreciation is to look at the book and the entries when you're doing your project. So project will be coming up soon, and I'll send out emails and do a video on that. But I want you guys to be aware that what we're going to have there, please reference your book, is an entry to depreciation expense of an amount and a matching, so this is an expense account over here, and an accumulated depreciation. That is an asset, but it is an asset called a contra asset. So a contra asset acts in the opposite direction as an asset. So an asset likes to be increased with a debit. A contra asset likes to be increased with a credit. So I promise you we'll touch on this again. We'll spend a full chapter together on these concepts. You won't be tested on knowing depreciation. Just be aware that it does exist. It will be on your project. On the balance sheet, the way we're going to show this, please reference your book as well, is we will show our equipment balance. So I'm using the same numbers as our examples in the books here. We're using the balance of the equipment that never changes, and we're putting this accumulated depreciation, which is a contra asset, in a negative direction. In Excel and in accounting, we use parentheses to show that negative direction. And then together, those are our net book value, or the value we're going to show as a long-term asset on our balance sheet. So let me know if you have questions on the discussion board. Again, you won't be tested on this concept. I just want you to know that it exists, and I promise we'll touch on it again soon in the chapter that we cover the fixed assets. All right, let's move on to our closing entries. Temporary accounts versus permanent accounts. So when you have a balance in your bank of cash, so cash is an asset, that is a permanent account. What I mean is, when it is the end of the year, 11/59 on December 31st, and you have $300 in your bank account, when the clock strikes midnight and it's the next year, and it's 12:01 in the morning the following year, you still have $300 in your bank account. These are permanent accounts. Another example is liabilities. If you owe somebody $1,000 at 11:59 on December 31st, when the clock strikes midnight and it's January 1st, you still owe that money. These accounts are considered permanent. Temporary accounts in accounting are revenue, expense, and dividends. These are accounts that when the year changes, we start over. So if you have revenues of $20,000 for the year January 1st to December 31st, when the clock strikes midnight and it's the following year and you say, how much revenue do we have for this new year on January 1st at 12:01 in the morning? The answer is 0. We had revenue last year, but we start over with our revenue the following year. Same thing with expense and dividends. To make this happen, we call these temporary accounts, and we close these accounts out to retained earnings. So here are our temporary accounts: revenue, expense, and dividends. Come over here with me. Retained earnings equals net income less dividends, or net income minus dividends. Another way to look at that, this is the same equation, is retained earnings equals revenue minus expenses, which is net income, minus dividends. All three of these accounts, which we're seeing here as our revenue, expenses, and dividends, these are our temporary accounts. We are going to close them out to retained earnings. All right, let's do an example. I'm going to do an example using dividends. So all three of these are in your book and in the slides and show how we close these out. But let's do an example with the T account with dividends. So in a calendar year, we have $200 of dividends. We need to close this out to retained earnings because it is a temporary account. When I close out this account, I want it to go to zero. As we can see on Dealer, dividends has a debit balance. So what we're going to do is we're going to close this out. To make this go to zero on a T account and a journal with a journal entry, I need to come in and make this $200 to go to zero. All right, so now we had dividends of $200. I am going to credit this account by $200 to make it go to zero. Here is my journal entry. See how my dividends are going to $200 here? I need a matching entry to retained earnings. So come over here to the retained earnings T account. Let's take a look at this. My beginning balance, because this is a permanent account, is $4,500. Retained earnings falls under owner's equity, and it likes to have a credit balance. So here we are with a credit balance. Now let's just think about what dividends do to retained earnings. Retained earnings here are increased with revenue and decreased with expense and decreased with dividends. The larger my expenses, the less I have to retain. The larger the dividends I pay, the less money I have to retain. So we're going to come over here. I need a matching debit. I'm going to debit retained earnings by $200. That's going to decrease my retained earnings balance, which makes sense. So what's happening here, I like seeing the T accounts in this, is that my dividends are going to go to zero. My retained earnings is going to be less because I'm paying out dividends, which means I have less money that I've decided to retain or keep. So here's our entry for retained earnings here. Please take a look at the books for the other entries on the revenue side and expense side, or send me a post in the discussion board and we can discuss those there. Now the next videos will have 2 problems that we're going to work for Chapter 3. Thanks.